has a couple of options that we can find. And when we look at our paper 1, you'll find that your question 1 normally remains the same. And then your question 2 is the one that changes, where you have your cash flow statement, your analysis, and then you have your auditing. So you have your 2, 3, and 4. But question 1 is the one that normally changes. This is according to past activities. This is according to past papers that we have seen. And if you then look, you see that this will change. In this case, we have the statement of comprehensive income and the statement of financial position. But if you go into another paper, you would find that it is question 1 that would normally change. Question 1 that would normally change. And if we come here, you see question 1 again has changed, where you now have the statement of comprehensive income and notes. So these are your notes to your statement of financial position. But your question 2, question 3, and question 4 would normally remain the same. These would normally remain the same. And then the next one would be a third option. Let's see if we can look at the third option. The third option, remember this is the second option. The third option would be where you have now the statement of financial position as your question 1, as always. Then you have question 2, question 3, and then question 4. So you can see that question 2, question 3, and question 4 have remained constant. And the ones that are changing is your question 1. Question 1 is the one that is changing, but 2, 3, and 4 remain constant. And then the next option, therefore, is option number 4. And option number 4 is where your question 1, question 2, question 3, question 4, question 2, 3, and 4 have remained constant. It is question 1 that is changing. And the way question 1 is changed now, you have the calculation of correct net profit after tax and statement of financial position. But you would see that in many of the past exam papers, when you are on the statement of financial position, it can be a full one, or it can be sections of the statement of financial position. That is where you can get the equity as well as the assets section. So these are some of the options that we normally have. So in the previous session that we did together, we answered question 1. We did together, and we did question 1. Together we did, and we answered question 1. But what we're going to do now, we are going to do question 2 today and question 3. Question 2 and 3. And the worksheet has been sent. The worksheet has been sent, and if you have not yet received it, we're going to try and forward it again. I know it's a bit of a challenge today as we got more kids coming into the session than we had anticipated. But nonetheless, it is good that we are able to assist. So I'm resending again that worksheet so that those that had not yet received it can receive it again. So these are the options that we have. In your June exam, your examiner can exploit one of these 4 options. Your examiner can exploit one of these 4 options. Option 1, option 2, option 3, as well as option number 4. These are the options that can be exploited. Now, we're going to come out and we're going to the worksheet which I have sent to you. So once again, my name is Mr. Simbi and welcome to today's accounting lesson. I'm delighted to have you. We had a few technical glitches because of the chat box. Because of the chat, I was not able to switch it off. So there is a few messages that are coming on. Please kindly ignore these messages. Find a way of ignoring them. If it's possible rather, that you can work on your screen that you can maybe increase your screen so that you don't see the messages, that would be best. That would be best. That would be best. Okay. Elias?
Yes, sir.
Are you ready, my guy?
I'm ready.
Okay, cool. So make sure that you have your calculators, your pencils, you have somewhere to write so that we can work together. If you can't hear me, it must be either your microphone or it could be the speaker, because Uwais here can hear me. So I'm going to be working tonight with Uwais. It's going to be helping me to do certain calculations as we go. But I need you to have your calculators as well. So you will find, guys, that when you are doing your statement, your cash flow statement, when you're doing your question 2, your cash flow statement, when you're doing your question 2, your cash flow statement, this normally would come with certain notes as well. This would come with certain notes as well. So at times you would find that this question can be tested together with note number 7 or note number 8. And at times there can be calculations that also has to do with your fixed tangible assets, which you're going to find as we are doing this question. So in this question, the examiner brought a bit of a different approach here. As you can see, this is part of the reconciliation note. Some of you call it note 1 to the cash flow statement. And you have to understand when you are doing this note that the examiner can test part of this note. Remember, when you're doing that note, that is the reconciliation note, I'm not going to write the entire statement here. All right. But you know, this is your note number 1. This is your note number 1 here. So the examiner can test certain parts of the note and not exactly the entire note. That can happen. The examiner may not test the entire note. All right. So you can find that the examiner can test maybe only the first part. So you'd see that when we are starting this, we start with our net profit. All right. So here you're going to find your net profit before tax. All right. And then after that, you have adjustments for. And then on the adjustments for, you can find that you have 2 things that would come here. Number 1 is your depreciation. Number 2 is your interest expense. Now, and then after that, you would get your operating profit before changes in working capital. Operating profit before changes in working capital. And then after that, you'd come now to your changes in working capital. And then on your changes in working capital, that is where you now come to your 3 aspects here, where you have your change in trade and other receivables, your change in trade and other payables, and remember, I should have started with change in inventory. So you also have your change in inventory, which I should have started with. Change in inventory. All right. And then you get now your amount that we would then call the cash generated from operations. All right. Now, an examiner can test the entire note. An examiner can test the entire note, or the examiner can test, I think in past papers, you have seen at times they only test this section here. An examiner can also test only this section. So there are sections that an examiner can exploit, or the entire note. This is what we've seen in recent exams. So my encouragement to you is prepare thoroughly. Prepare on the entire note. Prepare on the entire note that it becomes easy for you. In this activity, the examiner is asking us to calculate the following amounts in respect of the reconciliation of net profit before tax and cash generated from operations. So we are to do, number one, the change in receivables and the change in payables. You can see that the examiner wants us to do this one and that one. So they don't want us to do the entire piece. They only wanted us to do only these sections. Let's see if we can do that. All right. But my humble ask is, it is wise before Friday, before you step into the exam, that you know the entire note, because an examiner can exploit parts of this note. All right. But it is wiser to know the entire note. So let us come here then, and we want to do question 2.1, question 2.1, question 2.1. And question 2.1 is saying, calculate the following amounts. Remember, we're doing change in receivables and change in payables. And you must indicate whether it is inflow or outflow. So remember, when you are given the 10 minutes reading time, these are the things that you must read and you must understand, such that you can know whether it is inflow or outflow. Always, are you still with me?
Yes, yeah.
Nice one. So I'm going to begin here. So I'm coming here, and we are doing change in receivables. Change in receivables. So when we are doing our change in receivables, here is our trade and other receivables. The one place or the one thing that the examiner wants to test in most cases is, are you able to take out the SARS income tax? Are you able to exclude it from the calculations? Why is that so? Because your SARS income tax will be shown on the face of the cash flow statement. We are going to do a calculation on taxation today. So the examiner would therefore want to test to see, are you able to see that trick and then be able to do your calculations excluding that amount for SARS income tax. All right. So what we can see here is we have 2025 and 2024. 2025 and 2024. And we are given debtors control and we're given SARS income tax. So when I come here and I'm now doing my calculation, I have to understand that there is a trick that I can use here. Trade and other receivables are assets. These are assets. These are assets. And whenever I am dealing with my assets, I can come up with a formula that can assist me, where I can come and I say, my previous minus current amounts, then I trust the calculator. Previous minus the current amount, then I trust the calculator. How does that work? I have to understand that the 2024 is the previous year. This is my previous. And the 2025 is my current amount. So I am going to come and I'm going to say the previous year's amount is 1,303,500. That is my previous year's amount. And I am going to come and subtract my current year's amount. All right. My current year's amount is 3,167,000. 3,167,000. And then I would then come to my calculator. Always, can you see my screen?
Yes, sir.
Beautiful. I'll now say my 1,303,500 minus 3,167,000. And this will give me 1,863,500. So the answer is 1,863,500. But that answer is a negative amount. And I know that once it is negative, it is an outflow. So I trust my calculator that if my calculator gives me a negative amount, I am given an outflow. So I see here on my calculator, it's a negative 1,863,500. That is an outflow. So the answer here is 1,863,500, but it is an outflow. How do I know? My calculator does that for me. But if you want the explanation, when your receivables are increasing, it is a cash outflow. And the opposite is true. The opposite becomes true. I'm going to go on to the next one. And the next one will now say, all right, we are on change in payables. Change in payables. Change in payables. So when you come to your payables, we know that we are not going to include SARS income tax. So my SARS income tax is not included because it will appear on the face of the cash flow statement. My shareholders for dividends will not be included because I'm going to use them to calculate dividends paid on the face of the cash flow statement. And then I have accrued expenses. Then I'm going to add these two then. And here I only have the 1,323,500. Now, when I come to my payables, on my assets, Mr. Simbi said, if it's assets, it's current minus previous. Is that correct? No, I said it is previous minus current. This is on assets. On assets, it is previous minus current. When I come now to my liabilities, when I come now to my liabilities, when I come to my liabilities, on my liabilities, I am now going to say, remember, this is current and this is previous. All right, when you cash and cash equivalents, if I come here to another payables, all right, I'm writing it on the wrong place there. I'm writing it on the wrong place. Here I'm going to come, it's going to be my current and my previous. This is my current 2025, 2024 is my previous. When I am dealing with my liabilities, I am now going to come with a different formula. My formula is now going to be just as you see, because it's going to be opposite of this, which is previous minus current for assets. For liabilities, it will be current. It will be current minus previous. And then I trust the calculator, current minus previous. So that means I'm going to come here and I'm going to say 1,000,000 450,000. I'm going to add plus my 14,600. If I add these, how much do they give me? Always?
1,464,600.
1,464,600. And then I come and I say minus my previous year's amount. My previous year's amount is 1,323,500. So let's do that in the calculator together, ways so that the guys can also see. So I'm going to come here. Here's my calculator. So on my calculator, I'm now going to say 1,464,600 minus 1,323,500. 1,323,500. And that is going to give me, you get the same amount, Ways?
Yes, sir.
141,100. On your calculator, Ways, is it a negative or a positive figure?
Positive figure.
A positive figure means inflow. A positive figure means inflow. So we have a cash inflow of 141,100. This is what the examiner wanted in this paper. But I would highly recommend and encourage you, my good friends, that you do not stop here. Rather, it is important that you know your entire note. Know your entire note, because an examiner can test either the entire note or sections of it. Like in this case, we were tested here. Nothing can stop the examiner from testing even the top part or the entire thing. So you need to know the entire note. Okay, I'm going to move on, and I'm going to come now to my cash flow statement. Okay, I know that my cash flow statement is split into three parts. And the three parts are, it is your OIF, your operating activities, or your cash flow from operating activities, your cash flow from investing activities, and your cash flow from financing activities. So what would happen normally is, as a company, you're going to see, we need to operate. But what we need first, we need to get finance. And we are going to get finance, and our finance is going to take two forms. Number one, number two. Our finance, we're going to have own finance. And own finance has to do with shares, when we issue shares. And then we also have borrowed finance. And that borrowed finance, we're talking now loans. When a company has finance, it then takes this finance and it invests. This finance. And then how do they invest this finance? They can invest it in, number one, fixed assets. They can invest it in fixed assets or in other financial investments. We're talking fixed deposits. When a company has now the fixed assets, the company can now operate. We're talking operations. So you have to understand that there has to be a relationship between our financing activities and our investing activities. They have to talk to each other. That if you need finance, where do you get finance? And when you get the finance, how can you use that finance? Or if you see that you have invested in something, where did you get that finance? Those are questions that most examiners like to test. If you've invested in fixed assets, where did you get that finance? Already we can see that finance could be from shares or from loans. And then we invest it, which then allows us to operate. So it therefore means when I come to my cash flow statement, where are you, my friend? There you are. I know I'm going to start with my investing and my financing, but for me to understand it, I just had to break it down as I did it for you earlier on. So let's come and let's begin to write. On my cash flow from operations, I will get 4 figures. Cash, this is number 1, number 2, number 3, and number 4. It is of great importance that you know the entire format of the cash flow statement. It is wiser to be over-prepared than to be under-prepared. If the examiner brings sections of it, you are covered. If the examiner brings the entire cash flow, you are covered. So it is of great importance, dear learners, know the entire cash flow statement. You begin with the note, you come to the cash flow statement itself. And we know that we're 4 amounts here. But even with my eyes closed, I know that, number 1, my cash generated from operations is a cash inflow in most cases. That is, from all the papers that we've done, it would show an inflow there. And then the other three have always been and will always be outflows. And you can even see their names. The first one is interest paid. Paid means outflow. I can skip that one. Then I come here. Dividends paid. Paid means outflow. It's as simple as that. And the one that is missing here now becomes my taxation paid. And I know, even before I calculate the amount, it is going to be a cash outflow. Before I even calculate the amount, it's a cash outflow. Let's do this. An examiner can bring this entire part as is, or bring certain parts of it. So you need to know the entire part. It is wiser to be over prepared. Let's go on to the calculation. Taxation paid. Taxation paid. Now, I am going to do only one method. Those that have attended my classes, I think they'll be saying, we knew you were going to say that. I'm going to do the T account because of time, and then maybe in the other sessions, then I'll try to do the note as well. But here, I'm going to do the T account. So here is my T account. Here's my T account. That's not a straight line, Mr. Simbi. That's better. All right. There are several 1001 methods of doing this. But for this class, for this session, I'm just going to do a T account. And I'm calling it my taxation account. And then I have to be able to find my balances. My balances will either be in receivables or in payables. So here is the simple part. You know from grade 10 that assets have a debit balance. Assets have a debit balance. Assets have a debit balance. So if I see my SARS income tax, I know this is a debit balance. Debit balance here. So 2024 is the beginning of the financial year, and 2025 is the end of the financial year. So I'm going to come now, and I'm going to come down, and I'm going to say now, here is my other SARS income tax, but it is under payables. Payables, these are liabilities, and liabilities have a credit balance. Liabilities have a credit balance. So I come here. Where is my debit? Here is my debit. Here is my credit. Debit, credit. The opening balance is a debit balance. The opening balance is a debit balance. So for the sake of the lesson, I'm going to write in words so that you can see. So I'm coming here and I'm saying my balance brought down. This is the balance at the beginning, 32,000 on the debit because it is under my receivables. Receivables are assets. And then I have my double lines here. Under my double lines, I also find my SARS income tax here now. And this is under payables. And I know Mr. Simbia said, if it is payables, it is credit. It has to be under the double lines. So I'm coming to my credit side, but under the double line. So I'm coming in, I'm going to say balance brought down. And that is going to give me 15,300 like that. And I know that if it is BD here, it is going to be CD here, balance CD, 15,300. In your exam, it is the balances that can change. They vary. It can be debit, credit. It can be credit, debit. But your income tax amount is cast in stone. In other words, it will always be on the credit side. Your income tax amount is cast in stone. It will always be on the credit side. All right. So we come here and we now say, how much is your taxation for the year? There is the amount. Taxation for the year, 201,600. So I come here, then I say 201,600. What I was looking for is this bank amount there. So I then come, then I say, which side is bigger? This is 201,600. This is 201,600. So how much do I get here? Ways?
$154,300.
You get 154,300 over there. So it's a ledger account. You simply look for the side with the highest amount, and then you do that. Now, let me see how would I show it when I come here. So when you are now showing your answer here, when you're showing your answer, you are coming here and you are now opening your bracket. Here's your taxation paid. You are now saying, you began off with your 201,600. So you can say your 201,600, which is this one here, and you minus the 32,000, minus 32,000. You minus again the 15.3, minus 15.3, and you close your bracket. That is how you end up with 154,300. 154,300. 154,300. And that becomes your taxation paid. So in my class, I would encourage my kids to do these calculations on the side. You can open it here such that whoever is marking your paper, your teacher can see, oh, there is the calculation, and then you can bring it here as well. But there are different ways of calculating these figures, many, many ways. And I would recommend that you stick to the one that you understand the most. But it is of great importance that you know how to calculate your taxation paid and even your dividends paid. And with the dividends paid, it is much easier if you say your last year's final plus this year's interim. If we have time, we are going to try and exploit again another question. Okay, I'm going to move on now to the next part. So before I move on, I want to emphasize it is of great importance that you know the entire format of the cash flow statement. Know your entire cash flow statement so that if part of it are tested, you are sorted. If the entire thing is tested, you are still sorted. Okay. Let's go on now to cash flow from investing activities. Cash flow from investing activities. Waze, can you still hear me?
Yes, sir.
All right, cool. So with your investing activities, it is very important that you know that there are different ways of calculating this, many, many ways of calculating this, all right? Because on your investing activities, you are looking at your fixed assets. You're looking at your fixed assets. And when you're looking at your fixed assets, you purchase fixed assets and you also dispose some of the fixed assets. You sell. So when you sell a fixed asset, then you're going to get proceeds from the fixed asset. So two things will happen. You purchase a fixed asset as well as you selling a fixed asset. Let's read the information. So what were we given? Here is information A, and here's information B, ordinary shareholders equity, mortgage, bank overdraft. Then we come to fixed assets. And then we have land and buildings. So this is the previous year, and this is the current year. Now, in the previous year, our land and buildings were 5.6 million. In the current year, our land and buildings are 5.6 million. So nothing has changed on the land and buildings. We did not acquire new land and buildings, and we did not dispose new land and buildings. But if you come to your equipment, you can see that at the beginning, you had 745,000 worth of equipment at cost. And then we are told an old fridge was sold for cash at carrying value, very key, on 30 June. According to the fixed asset register, the cost of the fridge was 55,000. All right. And its carrying value was 16,000 on 1 March 2024. 1 March 2024 is the beginning of the financial year. And equipment is depreciated at 15% per annum on cost. So let's begin with this one, and then we go on to the next one. Let's begin with our equipment. So we know that we have a fridge that we have disposed. And there are several ways in which one could have done this particular calculation. Let's see if we can exploit all the avenues. Okay. Let me see if you can come here. We have been told that the fridge was sold at carrying value, but the fridge had a cost price of 55,000. So we know that the fridge had a cost, and the cost was 55,000. That's the cost of the fridge. And we have been told that at the beginning of the year, 1 March, the fridge had a carrying value of 16,000. So we know our carrying value already. So we're the cost. We normally in questions, you would come then and say accumulated depreciation, and that would give you carrying value. In this question, we were given the carrying value at the beginning, which is 16,000, like that. Okay, so that means there was accumulated depreciation here. Accumulated depreciation. Is it necessary that we can calculate it? Which method of depreciation are we using? Equipment is depreciated at 15% per annum on cost. On cost. That means I need only the cost to get the depreciation. But why do I need the depreciation for the year? I was told that the fridge was sold at carrying value. The fridge was sold at carrying value. So I also know that if I have carrying value at the beginning of the year, carrying value at the beginning of the year, I subtract depreciation for the year, it will give me carrying value either at the end of the year or on the day of disposal. Let me say it again. If I have carrying value at the beginning of the year, I subtract depreciation. It will give me carrying value at the end of the year or carrying value on the date of disposal. So I know that I have carrying value of 16,000. I need to know the depreciation so that I can get the carrying value. When I get the carrying value, I will know how much I sold this fridge for. So what do I need? I need to calculate depreciation. Let's come here then. We're calculating on cost. So I'm going to come in, I'm going to say, my 55,000, which is my cost, I multiply that by my rate of depreciation, which is 15%. And then, should I say 12 over 12? Why is 12 over 12 wrong? Why is 12 over 12 wrong? Because we did not have the asset for 12 months. The financial year begins on the 1st of March 2024, and we disposed it on the 30th of June. On the 30th of June. So I'm going to come here and I'm going to count. It's going to be March, April, May, June. Boys, how many months do you get there?
4.
So that means it can't be 12 over 12. Here it has to be 4 over 12. This is where some of you make mistakes. So with an asset that is being disposed, you always calculate from the beginning of the financial year to the date of disposal. And Wes, if you punch this in your calculator, how much do you get, my guy?
2,750.
You get 2,750. That is your depreciation for the year. So I can come now and say, if I've carrying value at the beginning of the year, I subtract my depreciation of 2,750. That should give me the carrying value on the day of disposal. How much is that going to be?
13,250.
13,250. Because we sold it at carrying value. An examiner could have said, all right, first, let me record this so that I do not confuse you, my little kids. Come here so that we can come here. Then I will now say here. What do I say? Sale of fixed asset. Sale of fixed asset. On the sale of fixed asset, I'm opening my bracket. The quickest way is to begin with my 16,000. I come here, then I say 16,000 minus the depreciation, which is 2,750. And that gives
Sorry,
me,
sir.
yes.
I think the depreciation amount was 800, sorry.
Say it again.
I think the depreciation amount was 800.
Okay. You get how much? 800.
800.
Okay. Can we punch it together?
Yes, we can.
Okay, let's try it together. Where are you, my friend? Let's see. So we heard the 55,000. Is that correct? Multiply that by 15 over 100. Multiply that by 4 over 12. Is that correct? Are you still with me always? Okay, so that's 2750. 2750. Okay. That gives us 2750. Thank you. Thank you, Waze. Thank you, my guy. Thank you. So that gives you 2750. 2750. So you're going to come here and you're going to say your 16,000 minus the 2750. And that's going to give you the 13,250. So you end up with 13,250 like that. Okay. I can see some of your hands, unfortunately, because of the number of learners on the platform, I cannot be able to unmute the microphones and allow you guys to speak. All right. Okay. You need to, if you need to communicate with me because of the class, please kindly text and then we'll be able to see how best we can go. All right. So let's continue and we will find a way. Let's go to the next one. Let's go to the next one. So we did the sale of fixed assets over there. All right. I've just lost my help there. I've just lost my help and I can't go and look for someone else, but we'll continue nonetheless. So let's go on. So we have the sale of fixed asset. So you would find that in most of the past exam papers, you would open a T account and you do the calculation. But in this question, it was a bit different. So what am I saying? You need to expose yourself to different ways in which the examiner can test. Like in this case, the examiner did not bring us all that information that would allow us to open a T account. But in this case, we were able to do the calculations in this much simpler way. I'm going to continue. Then the next one is the fixed assets purchased. It reads here on the information, vehicles, A new delivery vehicle was bought for cash on 1 December. No vehicles were sold. So, if a new vehicle was purchased, where do I find it? I see that in the previous year, I had vehicles of 2,520,000. That's in the previous year. And in this year, my vehicles are now 2.9 million. That means something. That means we have acquired new vehicles. We have bought new vehicles. When I see a change in the cost of my vehicles, it means I have bought new vehicles. So I can come here and I can now say, here, fixed assets purchased. On my fixed assets purchased, I open my bracket. I will now say, if I now have assets of 2.9 million, yet I had assets of only 2,520,000. Remember, this is at cost. What does that mean? Come here. Ooh. All right. Okay. Let's close that. What does that mean? It's going to be 2.9 million minus 2,520,000. 2,520,000. That will give me 380,000. 380,000. But again, I know these are my fixed assets. If I have purchased fixed assets, that's a cash outflow. If I sell a fixed asset, that's a cash inflow. If I purchase fixed assets, that's a cash outflow. Brackets must be there to show your inflow or your outflow. Brackets must be there to show your inflow or your outflow. I'm going to go on to the next one. But here is something that I've just seen. If the change in my vehicles cost shows that I have bought new vehicles, the opposite can also mean that I have disposed. In other words, if here it was 3,520,000, if there it was 3,520,000, I'm trying to think, will an examiner repeat the same thing? They might not repeat the same thing. They might just twist something. So if this was 3 million and now this is 2.9 on the cost, it therefore gives me the cost of the asset that would have been disposed. It would give me the cost of the asset that would have been disposed. This is when you look at the cost. But if I am given accumulated depreciation at the beginning and also at the end of the financial year, if I'm given accumulated depreciation here, let's say of 400,000, the difference between the two must then tell me of my depreciation for the year. So when I'm looking at my fixed assets, I'm looking at what the examiner tested in this paper. But what are the other areas that an examiner can test? You can be asked to calculate depreciation, and there is no rate for depreciation, but you are given a change in accumulated depreciation. It was 233, and now it is 400. The difference between the two amounts must speak to your depreciation. It's as simple as that. When it has gone up, it's telling you about your depreciation. Okay, so let us go again. I wanted to show what an examiner can have at their disposal. The one thing that will be missing here is the fixed deposit then. So in this exam, they did not test on the fixed deposit. But you would know that if your fixed deposit is increasing, we have invested in the fixed deposit. That means cash has gone out, so it becomes a cash outflow. But if you have a decrease in fixed deposit, it means one of the fixed deposits or the entire fixed deposit has matured, and therefore it becomes cash inflow. Therefore, it becomes cash inflow. I repeat, an increase in fixed deposit, we have invested in a fixed deposit. That's cash outflow. But a decrease means we have a fixed deposit that has matured. That's cash inflow. So once again, we're coming back here and we have seen on our cash flow. All right. We've seen on our cash flow that you can be tested on the O, the I, and the F at the same time. Or it can just be the O, or it can just be the I, or it can just be the F. The examiner can play around with this. Let's come now to the financing activities. Financing activities. Okay. Before I move away from this, you can see that when we purchased fixed assets, this is a decision that the directors have to take. This is a decision that directors have to take. So you would find that at times the examiner would say, what major decisions were taken? What major decisions were taken? This becomes one of the major decisions. What major decision do you see here? The purchase of fixed assets. It becomes one of the major decisions taken. Okay. Let me go on to the next one. And then the next one would then say, cash flow from financing activities, cash flow from financing activities, cash flow from financing activities. When I come to financing activities, I have spoken to this when I began. We are looking at our shares and we are looking at our loans as well. Shares and loans. Shares and loans. Okay. Let us see what we can do here. If you look, here's your information A. If you come to information B, you can see that you are given ordinary shareholders equity, ordinary shareholders equity, ordinary shareholders equity, not ordinary share capital. This is ordinary shareholders equity. That means in this amount, you have your ordinary share capital as well as your retained income. You have two amounts in there. And then we are then told that the directors paid an interim dividend on 31 July. 500,000 new shares were issued on 1 November at a price of 20 Rand per share. So this one was a bit straightforward. Okay, this one was a bit straightforward. So I'll come here and then I would then say, proceeds from sale of shares. Proceeds from sale of shares. Proceeds from sale of shares. So I'll come here and I'll say proceeds from sale of shares from sale of shares, or just the sale of shares. And then how many shares were issued? 50,000 new shares were issued. So we have 50,000 new shares here issued. And we are told they were issued at 20 Rand. Here is my 20 Rand per share. So let's see if we can have our adding machine again. It is 50,000 and each share is at 20 Rand, and that will give me 1 million. My 1 million is going to be cash inflow because it is proceeds from sale of shares. You'd find that in most cases, the examiner would require you to do a note number 7, okay? And it then depends on how an examiner wants to test this thing. But at times an examiner would require you to do a note number 7. That happens at times, all right? But in this case, it was not the case. It was not the case. Let's go on to the next aspect. So proceeds from sale of shares. This is also one of the major decisions. Now, an examiner can come and say, how was the purchase of the fixed assets financed? How did we finance the purchase of these fixed assets? We financed it by issuing shares. So we issued shares and we received 1 million. That is how we were able to finance the purchase of fixed assets. So they have to speak to each other. They have to speak to each other. So these are major decisions, but you have to know that there is also an aspect of relationship, that if you are going to have fixed assets being purchased, that's an investment. There has to be finance that is put into that investment. So a question can come and say, how was the purchase of fixed assets financed? And then you look at the issue of shares. That is one of the ways an examiner can bring some of these questions. Let's go on to the next one. The next one would be the repurchase of shares. All right, shares repurchased. Let's come to shares repurchased. Shares repurchased. I'm going to open a bracket. I have been told that 2,000 shares were repurchased at 40% more than the average price of 11 Rand per share. In all our classrooms, I know we have seen the triangle. In all our classrooms, we have seen the triangle. And I'm going to explain this particular question in this particular way. There is an average price. We know that the tip of the triangle is the cash flow. The tip of the triangle is the cash flow. Then on my left-hand side here, it is the ordinary share capital. This is your average price. And on this one here, you have your retained income. This is your above average. Now, according to this question, we have been told that the average share price is 11 Rand. The average share price is 11 Rand. And when we repurchased these shares, we paid an amount that was 40% more, 40% above. That means my above here is 40%. 40%. It therefore means if I am to get my cash flow amount, I can get this one if you want, or you can say your average price is, according to this question, 100%. So it therefore means what comes to your cash flow statement is 140%. So it depends on how you want to do it in this case. But it should therefore be what you want is 140. What you have is 100 multiplied by the 11 Rand. That is one of the options. Let's see. I can then come here and I'll say, I want 140. I have 100. And I multiply that by 11 Rand. That will give me 15.4. So my price per share here becomes 15 Rand 40 here. 15.4. That's the cash flow amount. And what we are doing here is the cash flow statement. So I can then come and I'll say, shares repurchased. How many shares were repurchased? 2,000 shares. So I'll come and then I'll say, 2,000 shares were repurchased. And what did we pay in full? It was 15 Rand 40. We close the bracket. And then I'll come and then I'll say 15.4, multiply that by the 2,000. And that will give me 30,800. So I'll come here, then I'll say 30,800. Repurchase must be in brackets. But if I'm an examiner in this place, I can test it in many, many different ways. Many different ways. Many different ways. I could have said 20% here on the 5,000, the new shares issued. I could have said maybe 10% of the unissued shares were issued. That's one way an examiner can test it. So you may be given your authorized share capital. Then you use your authorized share capital to calculate the number of shares issued. But as an examiner, I can also exploit this one. Maybe I can say 2% of issued shares were repurchased, and then you got your issued shares, and then you calculate. That means an examiner can be able to exploit any of these options. Just as we saw here, this was purchased at 40% more or above the average price. I'm going to go on to the next one. The next one is going to be here. And here I am going to look now at my loan. So with my loan, it's easy. I can just say change in loan already. Change in loan. Change in loan. Then I open a bracket. Change in loan. Change in loan. Okay. Let's look for the loan. We come here we can see that in 2024, let's erase everything so that you guys can see what I am talking about. Okay, we're here now. In 2024, I am not given my mortgage loan from Merchant Bank. It is unknown there. But at the end of the year, I'm given my mortgage loan, which is 2,880,000. Okay? Now, I don't know whether we have received a loan or we've paid a loan. Let's look for information that relates. So I have to look for something that relates to my mortgage loan. Is it bank overdraft? No. These are fixed assets. They mustn't have anything to do with my loan. Trade and other receivables? No. Cash and cash equivalents? We're talking about a loan. Then let's come to information F. Trade and other payables? No. Shares and dividends? Anything to do with a loan? No. Let's come and see information H. Financial indicator. We have the debt equity ratio. We are given the 2024 debt equity ratio. However, the 2025 was not given. Can we come up again? When we come here, we see that in 2025, we are given the mortgage loan. So we don't have a problem there. But we don't have the loan for 2024. But for the same 2024, I was given the debt equity ratio. Could it be that the examiner would want me to calculate the loan using the debt equity ratio? Let's see if that can be used to calculate the loan. Now, it is of great importance, my dear learners, that you understand that financial indicators can be exploited in the paper. When you look at your paper 1, when you look at question number 1, there is a possibility of finding financial indicators in a statement of comprehensive income. So you must be able to look at certain financial indicators. As we did last week. Last week, we had a financial indicator that we used to calculate our net profit after tax. We used the ROTCE. And then, if you come now to this question, you can see now you are given the debt equity ratio. And the debt equity ratio, the formula is your debt, which is your non-current liabilities, as to your shareholders' equity. Non-current liabilities as to your shareholders' equity. Now, do we have that non-current liability in 2024? Do we have it in 2024? No, we're looking for it. So we don't have this one. And then we are given the shareholders' equity. Are we given the shareholders' equity in 2024? There it is, 5.5 million. So I'll come here, then I'll say my shareholders' equity is 5.5 million. So I still am looking for my non-current liability as to shareholders' equity. And I've been given the answer. And the answer is 0.6 as to 1. 0.6 as to 1. And then I'll now say, if I'm to get an answer here, I'll simply cross multiply. Much easier this way. So I'm saying to get my non-current liability, which is my mortgage loan, I will now come to my shareholders' equity and I multiply it by 0. Because I need to get this one here. So let's see if we can have the adding machine. Then we'll now say 5.5 million. Multiply that by 0.6. That will give me 3.3 million. 3.3 million. So it means I can now come here and say my loan in 2024 was 3,300,000. 3,300,000. That was my loan. So if in the previous year I had my 3.3 million, if in the previous year I had 3.3 million, which is this one here now, is a loan. But now I see my loan is no longer 3.3 million. My loan is now 2,880,000 minus 2,880,000. That means we have repaid the loan. By how much? I'll then come and I'll say 3.3 million minus 2,880,000. And that would give me 420,000, in bracket, 420,000. Now, I'm just thinking, if an examiner can use the debt equity ratio here to give us the loan, what can stop the examiner from using, I'm just thinking, maybe Rocher. And then we get the shareholders' equity so that we can maybe get either the proceeds from shares, or I would want to encourage you, when you are doing calculations, also think of other possibilities. What can happen? Maybe I can use that. Maybe I only have my non-current liabilities, and then I can calculate using Rocher to get certain figures. I am just thinking what can be exploited such that you can get certain figures. I'm not saying it's impossible, but I'm saying in this world, there are limitless possibilities. Limitless possibilities. Okay, so let's go on now. Let's go on. The next one, I'm going to do the next part. So when I have done my investing activities, I have to know that they also speak to my financing activities. As we did earlier on, where did we get the money to finance the purchase of fixed assets? From the sale of shares. And then here we have repaid the loan. Where did we also get the money to repay the loan? From the sale of shares as well. And this can also be a major decision. Major decision. This is also a major decision. So we can see 3 major decisions that were done here by the directors. Now, this is a favorite for examiners, right? It's a favorite for examiners. You have to know this part here. In actual fact, know the entire cash flow, because any part can be tested, as we have just seen. Let's go. So as I am here now, it is on the change in cash and cash equivalents. So let me see if I can clear up. All right. Let's see if we can clear up to another tables. And then let's go up. And then we come up. Let's see here. We clear up as well. Okay. So we have 2024 and we have 2025. 2024 and 2025. Now, if you are going to come, and remember, you are going to calculate your cash and cash equivalents at the beginning, cash and cash equivalents at the end. And you would see that the examiner would give you certain amounts. All right. As you can see here, you were given the bank overdraft of 775,000 up here. All right. And then if you come now further down to your cash and cash equivalent amount, you will see that you have 2024 and 2025. And you have something here. What is that? That is your petty cash amount. All right. So let us then go up and let's see what we are given. Let's begin. You have a bank overdraft of 775,000. 775,000. That's your bank overdraft. All right. And then if you come now to your cash and cash equivalents, you see that on your cash and cash equivalents, you have 18,000 because of the petty cash. And if you come in 2024, you have a similar situation. But to make it easy, let us start with the one at the beginning. Let's start with the one at the beginning. At the beginning, which is 2024, this is my beginning, this is my end. Cash and cash equivalents at the beginning. This is cash and cash equivalents at the beginning, and this is at the end. So at the beginning, I'm going to see if I can squeeze in calculations here. All right. At the beginning, you had 405 of bank and petty cash is 10,000. So I would always encourage that you must come here and you say, you have 415,000. You must always subtract your bank overdraft. So you have 415,000. Do we have bank overdraft? 0. So it's going to be 415,000. I always tell my kids to subtract bank overdraft. In this case, it's 0. So that means you're going to end up with cash and cash equivalents at the beginning of 415,000. Then let's go do the same with cash and cash equivalents at the end. So what did we begin with? We began with the cash and cash equivalents. So our cash and cash equivalents are 18,000, as you can see here. So I'm going to begin with 18,000. And I'm going to come and I must always subtract my bank overdraft. I must always subtract my bank overdraft. So I'm coming here. My bank overdraft is 775,000. I close my bracket. So if I come here now, I'm going to say it is going to be 18,000. That's 180, Mr. Simbi. 18. That's 18 now. Minus 775,000. And that is going to give me a negative 757,000. A negative 757,000. I close my bracket. Now, What I need to do now is to go up, to get that particular figure there, to go up. And when I am going up now, when I'm going up, what do I do? As I go up, I'm now saying I have to punch in the calculator as they are. I have a negative 757 there. So I'm going to come and say minus 757. A negative 757,000, like that. And when I go up, I swap the sign of the second figure. We just don't swap signs. We swap the sign of the second figure here. So as you can see, it is a positive, and therefore we make it a negative. So it becomes a negative 415,000. I swap this, I change the sign from a plus 415 to a minus 415. So it becomes a minus 757 minus 415. And that will give me a minus 1172,000, like that, which you can be able to prove going down. You can be able to prove it when you go down. This has to be in your fingertips. This has to stay in your hands. This is very simple. So the key is begin with your cash and cash equivalents, subtract your bank overdraft. Come to your cash and cash equivalents, subtract your bank overdraft. So the new thing that the examiner brought here was your petty cash. But you know, petty cash, it is part of your cash and cash equivalents. Hence, we use the 415 and the 18,000 there. My good learners, I cannot overemphasize the need to know format. The need to know format. From what I have said from the beginning of the lesson, you need to know your format. Format of the note, not the entire note. If parts of the note are tested, you can still be able to answer. Wiser to know more than less. Let me see if I can go on now. Okay, so here I did touch on major decisions and how we can get the finance for such major decisions. Okay. Let us now come and we are going to calculate financial indicators. So financial indicators are of great importance. If you go back again to the structure that I gave you, the options for paper 1, question 1 is the one that changes, but your question 2 and your question 3, you would know it's a cash flow statement and calculation of financial indicators. Question 3 is going to be analysis and interpretation of financial information. So I would advise, if you find that question 2 is something that you can do with your eyes closed, why start with question 1? Because this is about motivation. Whatever can boost your ego, you need as much ego as you can get in an exam. So if starting with question 2 can boost you, start with question 2. Then you can still go to question 3. And you can even do your question 4. Then you go and finish off with question 1. Those are options that are still available. You need to start with questions that you have mastered. All right. So let us go now. 2.3. 2.3. So far we have answered 2.1, we have answered 2.2, now we're on 2.3, and then we come to 2.4. 2.3. Calculate the following financial indicators for the year ended. Okay. The formula sheet is always given at the back of the question paper. And you will see probably tomorrow, or yes, tomorrow is Thursday, probably tomorrow, there will be something that can be released again, which speaks to the formula sheet. You will see that we have a formula sheet which is color coded here in Gauteng, which shows you where to find a particular financial indicator. But I always encourage you, do not over rely on the formula. You need to have the formulas right in your fingertips. You need to have the formulas in your fingertips so that you can be able to calculate. So we are now going to calculate here, and we are calculating number one. It is the net asset value per share. The net asset value per share. Okay, so this is something that you would be knowing already, that if I'm calculating my NAV, my formula is my shareholders' equity over the number of shares in issue. The number of shares in issue, you multiply by 100/1. And my answer has to be in cents. My answer has to be in cents. I would encourage you guys, know all your financial indicators from your profitability. All right? You come to your liquidity. All right? You come to your solvency, your return indicators. You need to know all your financial indicators. But in this question, I'm going to focus on the ones that we were given in here so that I do not end up wandering off. So I'll restrict myself to this, but it is of great importance that you know all your financial indicators. But for the sake of this question, we're going to do this one. But my good friends, please know all of your financial indicators. So let's see. Were we given the shareholders' equity? We were given. How much was that? 7,140,000. 7,140,120. We divide this by the number of shares in issue, and we're told there were 498,000 ordinary shares in issue on 28 February 2025. So I'll come here and then I'll divide this by 498,000. And I multiply this by 100/1. Let's see how much that is going to give us. I'll come here and then I'll say 7,140,120 over my number of shares, 498,000, and times 100/1. And that's going to give me 1,433.8 cents. Because in accounting, we keep it to 1 decimal point. If you read the question paper in the 10 minutes reading time, it tells you round off financial indicators to 1 decimal point. So I'll come here and then I'll say I have 1,433.8 cents. Now, your NAV, your net asset value per share, your net asset value per share, it speaks to the value of shares in the company. And you will see as we are going to be commenting, I will also be indicating how we can comment. What do we compare the NAV with? What do we compare the NAV with? All right. Let's continue. I don't have voice anymore, so I don't know if you guys can hear me, but I think you guys can hear me. All right. If you can kindly text me so that I can know you can hear me. I don't want to be talking here all by myself. And I end up, all right, let's continue then. The next one, we're going to do that as we do the analysis, we're going to do that. All right. Okay, kindly. Oh, thank you. Who's this? Who say we can hear you? Thank you. Yes, thank you. Thank you, guys. You can hear me. Thank you so much. Thank you, Tato. Thank you, my guy. All right, thank you. Now I have a bit of confidence knowing that you guys can hear me. So the next financial indicator then, you can see this is your acid test ratio. This is part of your liquidity financial indicators. And at times the examiner comes and doesn't say liquidity. The examiner can come and say, calculate your working capital financial indicators. So you have to understand that when we talk about working capital, before I do the acid test, we have what we call working capital. This is simply talking to how, in simple ways, our capital is working for us. So even when you are then going to comment, you must look at it around these ways. When you talk about the working capital, it begins with a creditor. And this creditor gives us inventory. So we buy inventory from the creditor. That's on credit. So we must then be able to convert this inventory to debtors. That means we've sold it. And we must then be able to get cash from the debtors. The debtors must therefore be able to give us cash. And then we take the cash, we give it back to the creditors. That is working capital. So it's like a machinery that is working. It begins, the creditor gives us inventory. So inventory, remember, it comes at cost. That is your 100%. And then from that, we would then add our markup. Then we come to selling price here. And then we now have sold it to debtors. These debtors must then be able to give us cash. And we take the cash, we give it now to the creditors. And this machine keeps working. That's working capital. Now, you will see from this that this is your note number 4, inventory. And this is your note number 5, trade and other receivables. And this is your note number 6, cash and cash equivalents. And this is your note number 9, trade and other payables. So when we talk about working capital, we are looking at it around here. And if an examiner then comes and says, calculate the current ratio, when you're looking at the current ratio, you're simply saying, draw a line here. Because if I look at note number 4, 5, and 6, these are my current assets. And current liabilities. So when we talk about working capital, we are looking at this particular engine. How is it moving? How is it working? That's your working capital. So we have the current ratio from here. And you understand that the current ratio does not give us a clear picture of our ability to settle short-term obligations. In other words, I must know what is working capital. All right? Liquidity, I must be able to define liquidity. Is the company able to meet its short-term obligations? Those are simple definitions that you have to know. And then, once I know my current ratio, which simply means I'm taking my 4, remember, current ratio, it is your current assets. Okay, don't do that, Simbi, otherwise you're going to confuse the kids. Let's do it simple. It is your current assets to current liabilities, which is your note number 4 plus note number 5 plus note number 6 as to your note number 9, your current liabilities. That's your current ratio. And then the examiner can test you as well on the acid test ratio, the acid test ratio. So I normally tell this story in explaining the acid test ratio. It has to do with a guy that went to dig for gold. He went to dig for gold. So as he was digging for gold and he found a huge chunk of gold, and he went home, he told his wife, do you know what, dear wife? We are rich. We're super rich. Don't even pack the bags. Leave everything. You know what? Let's burn this house. We are rich. We have gold. And then they burnt everything. And then they went on to sell the gold. As they got to the place where they sell the gold, the guy who was buying gold then says, we can buy gold, but we have to test it. We have to test it to see, is it genuine gold? How do we test it? We pour an acid on it. 2 things will happen. If it is genuine gold, it's going to become clearer and cleaner. But if it is not gold, then it will, I don't know whether we call it dissolve or melting or converting to liquid. I don't know, but maybe it will dissolve. And then they poured the acid on the piece of gold and it dissolved. And the wife called the guy a fool because they'd burned their house. So that is what we call fool's gold. Fool's gold, it looks like gold, but not really it. So you can calculate the current ratio and you think the business is managing its working capital well. Yet there is a possibility that they're keeping too much stock. So we need to see our ability to pay our short-term obligations without involving stock. So it will be your current assets minus stock as to current liabilities. So what we're simply saying, it is note number 4 plus note number 5 plus note number 6 minus note number 4 as to note number 9. And the question is, why add it if you're going to subtract it again? Why bring it into the picture if you're going to take it out of the picture? So note number 4 is out. So you're looking at the ability of note number 5 and 6 to pay off note number 9. So let's see if we can calculate our acid test ratio. So we're going to come here and we're going to say on the acid test ratio, it is your current assets. All right, let's go look for our current assets. Were we given current assets? What were we given? So you can see here, we were not given the current assets, but what were we given? We were given trade and other receivables. This is your note number 5. So we say note number 5 plus note number 6 as 2, note number 9. That's what let's see if that will work. Let's see if that will work. So we will now say your note number 5. How much is that? 3,167,000. 3,167,000 plus your note number 6. What is that? Cash. This is note number 6. Cash and cash equivalents plus 18,000. S2. S2. My current liabilities. So we're looking at trade and other payables. So I have my trade and other payables. How much is that? 1,609,380. So I'm going to say S2 1,609,380. But I remember very well as I was doing this question, I remember very well when I was doing this question that we were given information about our bank overdraft. So I'm going to come here and I'm going to add my bank overdraft, which is my 775,000, like that. All right. So I like taking things slow. Let's see if we can have our adding machine. There you are. So we're going to come and then we're going to say 3,167,000 plus 18,000. That is going to give me 3,185,000. 3,185,000. S2. Then I say 1,609,380 plus 775,000. And that is going to give me 2,384,380. 2,384,380. And then it has to be S2 because it is a ratio. So what do? I divide everything by what is on my right-hand side. So I come in and I say divide by 2,384,380. That's how I get 1 here. All right. And then I do the same again. I divide by 2,384,380. And then if I come here, then I'm going to say my 3,185,000. I divide it by 384,380. 380. And that would give me 1.3. Then there's a 3. So to 1 decimal point, it's going to be 1.3 as to 1. 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 Okay. Then you have to know that when you are on your working capital, on the same scenario again, on the same scenario, remember, begins with your creditors. They give you stock. You take a stock, you convert it to debtors. You convert your debtors to cash. And then you give the cash to the creditors. We're talking working capital here, working capital. So we agreed that this is note number 4, note number 5, note number 6, note number 9. Okay? And then we can be able to calculate our stock holding period here. And the examiner can also bring the stock turnover rate here, which I've never seen both of them being tested in one paper because they equal, they mean one and the same thing. Then the next one, on your debtors, you can calculate your average debtors collection period. And with the creditors, you can calculate your average creditors payment period, like that. So these are financial indicators that are coming from your working capital. So even when you're commenting on working capital, you now know as you're commenting, if an examiner comes and says, comment on the working capital, you understand already. Number 1, you have your current ratio. Number 2, you have your acid test ratio. Number 3, you have your stock holding period, stock turnover rate. Number 4, you have your average debtors collection period. Number 5, you have your average creditors payment period. These are all within the working capital. This is what working capital talks about. Working capital. I'm now going to move and I'm going to calculate the last financial indicator here. The dividend payout rate. The dividend payout rate. All right. There's several ways in which this financial indicator can be tested. All right. And at times, certain information can be given to you that allows you to calculate it much more simpler. But at times, information is not given, and you have to use the restricted or the limited information that you would be given. So, if we're to calculate our dividend payout rate, what are we given? What are we given? So normally what we do towards the end of our session in these classes, we normally would give chance to certain learners that want to give it a try and say, Mr. Simbi, I want to explain this one. And then we would call it a day. So we will not be able to do the next part. That is the analysis and interpretation because of time, as there are other commitments. But I do know that we do have another session again that is tomorrow. Okay, we have another session again that is tomorrow. And that session will be able to assist you guys in calculating several and other financial indicators. All right, so I want to give you just 1 minute. If there's anyone who can say, Mr. Simbi, I want to give it a try. You can see it's 5 marks here on the dividend payout rate. As we are close to concluding, then we do 2.4. I want someone, if you can do it, if you're able to do it, to crack it, and then you can quickly send me a message, and then I can unmute you, and then you can explain. Remember, we did the same thing in last week's class, where I can allow you to do this particular calculation. Last week, we had a financial indicator, and we gave someone a chance to do it as we come towards the end of the session. We try not to do it during, so that we do not disturb other learners. So now that we're coming towards the end of the session, I want to give the opportunity to someone who says, I can calculate the dividend payout rate. And if you're there, I want to give you the opportunity. All right, so you can either send me a WhatsApp message. So as I'm speaking now, I'm trying to give you time. I'm trying to give you time so that you can be able to do that. You can be able to do that. I'm trying to give you time so that you can be able to do that. You can be able to do that. I'm trying to give you time so that you can be able to do that. Let me show you more information here as well. All right, more information as well. There is more information, because normally in the exam, you would know, as many would have done, if they had to calculate dividend payout rate, the options that we normally use are not given in this exam. So we want to see what other option would you have exploited? What other option? And your formula sheet also informs you of how to do this. So I'm going to give 1 more minute. If there's anyone, please kindly send me a message. This is how we always do it. And then I'll only give one person the chance to try and explain. But as I'm doing that, I'm trying to buy you guys time. I'm trying to buy you guys time so that at least we can get someone who can say, Mr. Simbi, I think I can try it. Mr. Simbi, I think I can try it. All right, here is more information. Here's more information. And then let's go again. Here's more information again. Here's more information again. Right, I want to give you guys a chance. If there's anyone, I want to give you a chance. I want to give you a chance. I've not received the messages yet. I've not received the messages yet. Still quiet this side. Okay, still quiet. One more minute. I'll show you again. I can see no one is yet. No one is yet. Okay, I got a message here which says, "Say, can I try?" Let me see. But before I give you the chance to try, just send me a picture of what you'd have done so that we know if we're on the right track. All right. I try that we become as engaging as possible. Please send me a picture of your calculation so that I can allow you to speak. Please send me a picture of your calculation so that I can allow you to speak. So remember, you need that information as well. You need that information. You need information A. You need part of information A, and you also need part of information F, as well as part of information G. Part of information G. Okay. All right. Let's see if we can do it together so that we do not continue dragging. So if you're to calculate your dividend payout rate, the formula is, there is the one that normally comes. And we always do that one, whereby we say it is your DPS over your EPS. All right. But it is very important that you know, how do you get your dividends per share? All right. So you know that your dividends per share, you are talking about your interim dividends plus your final dividends. So this is speaking to interim and your final dividends. And when we talk about earnings per share, we're talking about our net profit after tax. Net profit after tax. All right. So I know that most of you know this DPS over EPS times 100 over 1. But you then neglect to understand this, that your DPS is speaking to your interim dividends and your final dividends. All right. And then that's why you find at times an examiner can say, calculate your interim dividend per share or your final dividend per share. And then when you're talking about EPS, your earnings per share, you're talking to your net profit after tax. All right. So let's see if we can do that together. So let's begin with the top part. So the top part, we need our interim plus our final. Okay, to do that, let's get a bigger screen maybe. So we would need, as we said, DPS over EPS. And as we spoke about DPS, you know that it is your interim dividend plus your final dividend. Okay, so, and then when you talk about your earnings per share, you're talking about your net profit, and this is after tax. All right, so I'm going to come here and then I'm going to say, your interim dividend for this year, do we have it? If we come to our information, we are told that dividends paid as per the cash flow statement. You remember when I spoke in the cash flow, I told you that dividends paid, if you're doing dividends paid, the formula is last year's final. The formula is last year's final plus this year's interim. That is your dividends paid. So we're being told our dividends paid is 252,000. Our dividends paid is 252,000. That is equal to last year's final was 162. So 162 here plus this year's interim. So we can get our interim dividend. We simply then come and say, it is my 252,000 minus my 162,000. That would therefore give me 90,000 as my interim dividend. So my interim dividend is 90,000 here. Then I say plus my final dividend for this year. My final dividend for this year was given 129,480. So I come here plus 129,480. And then I divide this by my net profit after tax, which is 518,400. 518,400. Remember, it has to be multiplied by 100 over 1 because the answer has to be a percentage. So I'm going to say 90 plus 129,480. So I'm coming here, I'm going to say 90,000 plus 124,000. Mr. Simbi, 129,480, 129,480, 129,480. And that's going to give me 219,480. 219,480. And I divide that by my 518,400. And then I multiply by 100 over 1. Okay, so let's see if we can divide that by 518,400. And that is going to give us, remember to multiply by 100, and that would therefore give us 42.3. 42.3%. Now, what percentage of your earnings was given as dividends? What percentage of your earnings was given as dividends? In this case, we can see 42.3% of our earnings were given as dividends. That therefore tells us that 57.7% of our earnings were retained. This is what it means. So such a company would be having plans of expansion. Such a company would want to have ease of cash flow. So you would find that maybe such a company is equalizing dividends because in the previous year, maybe they would have given 98.2% of earnings as dividends in the previous year. So in this current year, they bring about equalization. They are giving less and they are retaining more. So when you are calculating your dividend payout rate, you are looking at what percentage of your earnings were given to the shareholders as dividends. Okay. And then the last part of this question, and for the night, is 2.4. The directors should be concerned about the cash resources of the company for the year ended 28 February 2025. Give one reason with figures. Okay. Now, this is something that we can see already because the directors are concerned about the cash resources of the company. At the beginning of the year, and I did say it, at the beginning of the year, we had a positive cash position of 415,000. This was favorable cash, but it has now moved to an unfavorable cash position of 757,000. So I would be concerned because, number one, so we are looking at the cash flow now. We are analyzing it. Remember, it has to talk to our cash position. All right? So my first point is, as we saw, let me bring this one here, and then I'll bring this one so I can write the answer there. So I'll come here and then I'll say my point number one is that the cash and cash equivalents, the cash and cash equivalents have changed. They have changed from a favorable balance, of 415,000 to an unfavorable balance of 757,000. That is a cause for concern. The directors should be concerned about the cash resources. Okay? And then the next one, you can see here that we have a negative net change here, a negative net change. All right? So I can say the net change in cash and cash equivalents is an outflow. It is an outflow. It is an outflow of 1,172,000. There is an outflow of 1,172,000. That means the company's operations are not generating enough cash, The company's operations are not generating enough cash. That is what it therefore means. My good friends, I would have loved to do question 2, but the body is now saying no. Time is saying definitely not. And I know that tomorrow we have a live session. The same way you got the link for today's class, you get tomorrow's link again. And tomorrow's live class is at 2:30. So what I'm going to do now, I have seniors here. I have Mem Helen, who is also here. I'm going to stop sharing, and then I'm going to give the chance for Mem Helen to